Blog Talk Radio.
Good morning from sunny California. It's 7:30 in the morning here. It's a beautiful day. The weather's finally cooling off. Today we're talking about an item that is missed so many times, and so much money is paid in taxes that are not legally owed, not required. And it happens with resident aliens, and by aliens I mean somebody here legally, not from another planet, and they are from a host country, a country that has a tax treaty with the United States. And not every treaty is going to have this special clause that I'm going to talk about in a few minutes, but it's mostly the European treaties and, of course, the United Kingdom. So first, a little background. When is an alien taxable in the United States, and what is the alien taxable on? So our tax law divides aliens into three classifications. The first two are really straightforward. You probably heard the term many times, non-resident alien, and the other term is resident alien. Now, the important factor is to realize these are income tax terms and not estate and gift tax terms, which will be briefly discussed at the end of the show. So a non-resident alien is what you would expect somebody living outside the country, maybe coming here for vacation at the very most. So most people who are living in the United Kingdom, in the European Union, are non-resident aliens. They will pay income tax on U.S. source income. So if they have income from a domestic corporation as a dividend, the tax rate is 30%, except for those that are in a treaty country, and usually it's a rate of about 5 or 10 or 15%. They will pay no tax on stock market, short or long-term capital gains, commodity gains, no tax on life insurance income, no tax on bank interest income, and no tax on money market interest income. Those laws go back to the Great Depression, not the Great Recession, the Great Depression, when we had a wise Congress that knew how to work together, get things going. They wanted the foreign person to put money in this country. We were poor, and Congress knew that everybody looks at after-tax returns. The resident alien, here it gets a little bit confusing. There's a green card, and green card people are resident aliens with one big exception, and that's the third classification, which is the big tax planning technique. And people who spend too much time in the United States, known as the substantial presence test, become U.S. resident aliens. The simple rule is if you're in the United States for more than half the year, you are a U.S. resident alien. Once again, only an income tax resident alien, not a estate or gift tax. And there's a kind of a funky item where there's a 3-year test and you average the days. The simplified equation, if you're more than 120 days here in the United States over the last 3 years, you are a resident alien, but it's not that simple. It's a math equation, and one has to do it for each person. When you're a resident alien, you pay tax just like an American on your worldwide income. And many Europeans and U.K. residents take their concept that the money has to be deposited in the United States before they owe tax, and they apply it to their U.S. tax return. And that, of course, as we Americans know, is not the case. Regardless of where your bank account is, you still pay tax on the money it earns and money that went into it. So that's the technical stuff, a little bit boring. That's not the tax planning stuff. The tax planning stuff is for the European who is in the United States a lot. He actually passes the substantial presence test. He's here all the time, or she's here all the time. And quite often I come across a person who's here on an investor visa. They may have been living here for 5, 6, 10 years. They have family here. They have a business here. They have a home here. They're really active. So the thought is that most tax preparers is that they must owe tax here, and but that's not the case. And we're going to be reading in the next minute or so one page from an IRS publication. I'm going to give you the publication number. It's 519. That's 519. We're reading page 36, and this is a neat publication. It has different chapters. This is chapter 6 on dual status returns. So dual status is the person that would be a U.S. tax resident, except for there's a treaty. So we're going to talk, and this is an IRS publication. They're talking about Sam R. Brown. He's a United Kingdom citizen and resident, and he is single. He is here in the United States having a good time. I actually have a client like that. He's in California having a fun time. And here's the story from the IRS, page 36. He temporarily entered the United States with an H-1 visa to develop a new product line for major product company. So the name of his employer is Major Product Company. An H-1 visa is like an investor visa. You're here for a short period of time. If you keep hiring Americans, it gets renewed indefinitely. Okay, the story goes on to say, he arrived in the United States March 18th, 2010. And he left May 25th, 2010, returning to his home in England. The major product company later offered Sam a permanent job, and he returned to the United States with a permanent visa on September 10th, 2010. Now, the word permanent visa, when you see that word, that's what's also known as a green card. He could be here for usually 10 years. Back to the story. During Sam's temporary assignment in the United States, the major product company paid him $6,500. He accounted to his employer for his expenses for travel, meals, lodging while on temporary assignment, and was reimbursed for his expenses. This amount was not included in his wage statement given to him as he left the United States. And in this case, as a note, the employer gave him a form, a W-2. After Sam became permanently employed, his wages for the rest of the year were $21,950, including reimbursement of his moving expense to the United States. He received a separate form, a W-2, for this period. His other income in 2010 was as follows. Interest income paid by a U.S. bank. Now, this is interesting, going back to U.S. source income. Interest paid by a U.S. bank when you do not have a business here and it's not tied to your business is exempt if you're a non-resident alien. And we're going to find out how Sam walked the thin line boldly and was on both sides of the fence here. So March 31st was 45, and I won't confuse you with the details, but he made some income in June, September, and December from the U.S. bank. Dividend income paid by a major product company. So he owned stock in major product company. And in April, he received $120. July, he received $120. In October, $120. Interest income paid from United Kingdom banks, and he received it throughout the years. March, $90. In June, $110. And all the way through December when he received $120. Sam paid the following expenses while he was in the United States. A moving expense, state tax in the state of Virginia, it looks like here, contribution to U.S. charities. Before Sam left the United States, he filed Form 1040-C. Now, that's overlooked by a lot of people. that is an important exit tax form. It's also known as a sailing permit from the ancient days when people left here by sea. And you want to be sure that you're doing that, or if you're a CPA, that you're watching this form so your clients do not have a problem with immigration when he tries to re-enter the United States. Okay, so here is where most CPAs get the clients into big trouble. They do not file the Form 1040-NR. So in this example, even though Sam was here more than enough days and he would be a U.S. tax resident, Sam completes a Form 1040-NR, which is a non-resident, as follows. He puts on his name, of course, an SS number. He prints on top of the form dual status statement across the top in big letters. On line 8, Sam enters his salary while a non-resident. He enters the state income tax withheld from his salary as an itemized deduction. On page 4, Sam also reports the not effectively connected income. That is the income from the U.S. bank. Let me back up a little bit. The term not effectively connected U.S. income means income not tied to a U.S. business. So Sam reports the non-business income while he was a non-resident. So that's the income from the American bank and the U.K. bank and the dividend income from major party company. And there's a special schedule for that. I'll give it to you just in case you want to make a note, NEC. He figures his tax on the dividend at a rate of 15%, which is the rate under the tax treaty, Article 10, with the United Kingdom. Sam also reports the $36 amount of tax withheld from his employer, and he will receive for that a credit. The publication goes on to say Sam is not required to report the interest credited to his account by the U.S. bank during the period he was a non-resident. Interest on deposits with U.S. banks is treated as income from sources in the United States, but is not taxable to the non-resident. The interest income received from the United Kingdom while he was a non-resident alien is also not taxed. So what's going on here is that the United States treaty with the United Kingdom holds that unless Sam has this green card, he's not a U.S. resident. So he could be here working away, having a great time, making U.S. source income, investing in the stock market, making huge capital gains, depositing them into his domestic brokerage account or domestic bank account. And as long as he's here on an investor visa or some other non-green card visa, he is a walking tax haven. So when you get into your tax planning, you really want to be sure that you take the time to look at the treaty. We have a treaty on our blog, and to find the blog, you type in the words Brian Dooley CPA blog, and it's going to pop right up. The other aspects that people quite often miss is the difference between estate tax and income tax. So here is a big malpractice risk if you're a CPA or attorney listening in. The fact that somebody's here, even with a green card, does not make them a estate tax resident or gift tax resident. Surely with an investor visa, which is renewed every few years, they clearly are not. The concept for state and gift tax is domicile. So the malpractice risk is, I had a client like this just last March. His tax advisors were doing some great estate tax planning. He was a European here on an investor visa. He had 3 businesses going. He was married here, had 3 children, a family of 5, and husband and wife were about ready to give $10 million into a estate planning trust. Because as we know, the exemption for year 2012 is a little bit more than $5 million per individual. Sounds pretty simple. But the European is not domiciled in the United States. He has no exemption. He has 0 gift tax exemption. His estate tax exemption is $60,000. If they had made that gift of U.S. assets into a trust, foreign or domestic trust, they would owe gift tax on the full amount. And if they had included any grandchildren, they would also be subject to the generation skipping tax. So this is a big malpractice risk. However, on the very bright side, the European client had a lot of assets in Europe, non-U.S. property. He can gift a lot more than $10 million. He can gift any amount of those into a trust for his children or even to his children and not pay any U.S. gift tax. So that's the big difference in the two. Now, this topic is covered in Chapter 6 of my book, International Taxation in America. You can get the book on Amazon. The topic about the green card and the treaty, that actually is not covered in my book. That's a pretty sophisticated item. I'll be adding it to the 2013 edition. I will add it as a hyperlink because IRS has this publication on their website in HTML format, web page format, and it's easy to read and it's always up to date. So as IRS changes their example, you will have it. So I enjoyed spending my morning with you. I hope all of you are having a great time. As some of you know, this show is being recorded. You can replay this show either by calling in to my special phone number or going to the website and just clicking on the link. Wish you all a happy day, and it's bye for now. Or tomorrow is a great topic, is the foreign trust planning myth or a fact. We're looking at the Nat King Cole case. Nat King Cole has his family has one of the more famous foreign trusts audited by the IRS, and the IRS was defeated not once, not twice, but 2.5 times. Until tomorrow, have a great day.